some oil fear maybe creep into the market, or just a much needed pullback in tech stocks? Do you think that the equity market has been out of line rallying tech the way it has, or is there truly a part of this economy that can still function just fine if we're stuck inside?
I think a whole lot of the economy, including a good part of tech, Oliver, are due for a further correction. We haven't seen the end of it yet. And I think what you're seeing is that they're going down in stages. You said earlier in this program that gold has not participated in the rally as the dollar has, and the 10-year Treasury yield has not benefited to the same extent either. But they are all going one after the other. If you take a week or 10 days together, then you see the different asset classes all behaving more in tandem. And you're seeing also that what is happening to copper that you made reference to, Dr. Copper is the reference to how the world economy is doing. And there is going to be more weakness in copper. I think gold price is going to rise, and the 10-year Treasury yield is going to go down, and the dollar is going to go up. It may not all be in the same day, but you're going to have all of those developments one after the other during the coming days.
Komal, how come the 10-year, not to downplay the fact that we're still at 50 basis points, but how come the 10-year hasn't been moving even quicker already? The Fed piled even more into their bond buying program, and they've been dialing down the last couple weeks here, but the don't fight the Fed is still there. The risks that we see for GDP estimates and everything else are as abysmal and doomsday as they've been in decades, basically. So what's going to need to happen? What's the shoe that needs to fall here to get the stock correction you're describing and another big ramp in bonds?
Today, Oliver, I think, again, you discussed this earlier as well, is a day when you go for the cash grab. You went into the dollar. You went into the dollar for security a lot more than you did with the Treasury yield or with gold. But then it changes, and I think it is just a matter of time before the 10-year Treasury yield goes down a lot further and, again, not only test the lows of March 9th of 31 basis points, but actually goes below it. What are the reasons why I think that is the case? The oil market this week is giving you a message of intense deflation in the global economy. The fact that even though the May contract has come back positive today, the June, July, August contracts have all fallen in price quite significantly, says to you that the oil market at least does not believe that the US economy is going to turn around in a V-shaped manner. That's not going to happen. If that is the case, and if you give it a few more weeks' time, I think the Treasury yield is likely to go down further at a time at which, instead of just holding on to cash, people are going to go into US Treasuries as well as a safe haven. So I think I take a lot of heart from what is happening in the oil market this week to suggest that the US Treasury trade is still very safe indeed.
What will require us to revisit that notion? I see that obviously we've gotten a bid back into bonds after that high correlation sell-off that happened in early March. I'm looking at data from Nick Collis over at DataTrek and his team about the expected returns an investor should have based on the rally we've had in TLT. And just to bring up a few numbers, year to date, 25% higher, 1 year, 38% higher. Their point basically is that when something like this trades like a momentum trend, that the expectations for the forward return over the next 30 days are all negative in the 5 times or 4 instances in history where it's had that big of a return. Ray Dalio said to obviously quite a bit of commentary last week that you'd be crazy to buy bonds. I mean, are we approaching the limit here if investors are losing faith in the Treasury and would rather just hoard cash?
Oliver, I have heard this for the last 4 years, various money managers talking about the bond trade is a dead one. And I was repeatedly saying that the 10-year was going to go below 2%, it was going to go below 150, below 1%, and now I'm suggesting it is going towards zero. So what is going to change it is not a consensus of major money market money managers saying the opposite. What is going to change it is come 2021, we are going to be left with an immense amount of stimulus on the part of the Federal Reserve, the US Treasury. We are going to see the economy coming back, but the politicians are going to be reluctant to pull back on the stimulus. That's our experience from post 2008 as well. So if they let the stimulus continue, even as the recovery starts, and they do not reduce all of the positive stimulus that they have provided, the 10-year yield is going to shoot up and you're going to see the dollar plummet. The things that we are talking about will all get reversed in 2021 if there were not reasonable and responsible economic policy. That is what is going to cause the 10-year yield to turn around. It is not yet. We are looking at slower growth, deeper recession, and a deflation in the short term, and all of those are positive for the 10-year bond.
And Komal, to your point, when you were with us on March 5th, you said there were still more gains to come for long-term bonds, and we're up 8% on TLT since then. So far, that's been the right way to view it. When we look at what the stock market is trying to say, Komal, I know there's a lot of folks that they'll go, you know, the Fed is buying and the Fed is there, blah, 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 you should ignore the stock market. I'm not so sure because the timing of it is a little bit curious. I mean, the Fed started getting extreme in their efforts in early March, right before the market really started to tank. And then it also, it seems to be the only asset class, stocks, that at least have reflected over the last month a hugely improving picture on the virus front in terms of curves flattening, turning over, progress being made to potentially get to a discussion about reopening instead of death numbers that are way higher than what we're getting. So is the stock market totally off here? Is there a possibility that it's trying to sniff something out that could be a faster return to normal than being assessed in other markets?
I would answer your question in a few parts, Oliver. First of all, I think, yes, the stock market is off the proper path, and this wouldn't be the first time. We have had two recessions other than what we are in right now. We have had two recessions in this century. In 2001, from March to November, we had 2007, December to 2009, June. And in both cases, the equity market missed it. Let's say the Great Recession, and you were following the equity market as a signal as to what to do. You would have gone in October 2007, 2 months before the recession began, the S&P 500 hit a high. So that was the time I said we are at the verge of a recession, despite the fact that equity market was at a high. So you cannot take the cue from the equity market. It is hard to say why equity investors remain bullish far beyond the time when it is appropriate to be that way. But the bond market in both of those recessions gave a much better signal for what is ahead. So what you're seeing today is a 10-year yield continuing to go down. You're also seeing the oil market, the copper developments are continuing to validate that move. And you're also seeing, anecdotally, the increase in unemployment. The deterioration in the economy doesn't suggest that there is a quick turnaround. So for all of those reasons, I would suggest trust the Treasury bond market. Do not trust the equity market in looking for your expectations over the next 6 to 12 months.